thank you for coming, folks. My name is Dan O'Brien. I'm talking tonight along with Gregg Ibendahl. I'll start out talking about grain markets and planting intentions. The reports have just happened, and Gregg will follow up with the discussion of cost production issues. So the presentation that you have would be you're seeing the selected parts of this. There's a full presentation that Rich will have on Ag Manager thereafter that you can look at. I think you may have received a part of that. So let's go ahead. You can't come up with other than maybe livestock production and what Brian talked about and what Michael will talk about, a set of topics that are more interesting and more vital right now. Okay, let's see here. Okay. Anyway, we did have a crop report and well, excuse me, not a crop report, a planting intentions report. And amongst the principal crops in the United States, you can see that, yes, there's a recovery in corn and soybean acres. Some of that, of course, when you're comparing that to 2019, we had a lot of prevented planting, all manner of crop problems. So, of course, corn, soybeans in those eastern Corn Belt states are the main recipients of the increases that you're seeing. You also will note sorghum increased some. Winter wheat was down about 1% or so, thereabouts. Spring wheat down about 70 million acres. And of course, this is the prospective planting report, and there'll be another report that will come out at the end of June, dealing with actual plantings. And there's a lot of work to be done between now and then. And in fact, when a person looks at the how the market responded to this report, there's a lot of anticipation that the numbers will change. We're going to talk about whether that's going to happen or not, and as we go forward. There was also a stocks report, and mainly following from lower crops, you saw stocks all lower. The main ones for us, of course, would be the corn number, as well as the corn is down, sorghum's down, soybeans were down, wheat all down. That the number in the red that you see there would be the percentages. Now, as we're talking about in the age of coronavirus and all the different factors that affect the market, the impact on the U.S. economy and the response of the federal government with the backing of the Federal Reserve have caused quite a bit of volatility in the financial markets. Of course, you can see this chart as it shows the U.S. dollar index that we've had just within the last several days, tremendous volatility up and down in the value of the U.S. dollar. And I think overall that generally and Brian, you want to comment on this later, that'd be fine. We talked about some last week. The dollars, because of the actions of the government, U.S. Fed, seen as a safe haven. It's not that we're doing tremendous. It's just that so many other places don't have the capability. So in terms of agriculture, this is a big issue in terms of exports. So we may have some physical opportunities to export grain, depending on how the coronavirus hits these other countries and their logistical situations. But one hurdle that we're going to have to overcome, and at each step, will be the high value of the U.S. dollar. Working against U.S. crops being affordable at the local level. I'm going to talk about corn markets first, and several key points. And I saw an earlier question that came in. You start looking at what's happened in the ethanol market. A lot of consternation as the U.S. economy has been damaged. Oil prices have gone lower. So along with the U.S. economy having issues, we have the Saudi Arabia and Russia entering into oil price race to the bottom, I guess, to see who can stand firm more. So pretty rough time in the ethanol world. Now, a lot of discussion about about the impact on plants, how much corn usage will be used. Conservative number to start out with would be 200 to 500 million. We hear talk like that, and there has been, you have seen a response in the DDG market as users, particularly on the dairy side, other livestock species that particularly value DDGs have been anxious to get hold of those supplies, given what they anticipate in terms of ethanol plant issues. Also, you hear rumors of even foreign countries, China, being in the market to look for bids for DDGs. So some worry about those folks that use that. So what's the math on this? I think it's a fair question. If Greg Christick is on the call, Greg could give a concise, well detailed discussion of this. But basically, we're looking at the amount of motor fuel used in the United States. About 100 in 2019 is about 142 billion gallons, I believe. I have the right scale on that, and we blend according to the renewable fuel standard about 10% of that. And of course, you've got some other advanced fuel blends in play there. You've got E15 and E85 at places in play. But in the broadest aggregate, if we take a 10% hit on motor fuel usage, instead of 142, you're down to 128. If it's more than that, you just keep taking that down. And to the degree that corn's involved, if we're using probably a conservative number nowadays with new technologies, about one bushel of corn makes about 2.8 gallons of ethanol. Well, you can do the math. It does provide support for sure, as motor fuel usage was anticipated to fall off. There'll be a scaling back of what's needed and what's required in terms of the amount of use of ethanol. And with that, we can back figure what the downside is. Planting prospects 2020, the USDA came out and projected 97 million acres to be planted. Pre-report expectations and post-report expectations for about 93 to 95. But there's a caution here. Lance Honig, USDA NASS leader, Kansas native, basically came out here in the last day or so and said, well, 97 million acres is probably a number that's going to hang around. So I remember last summer that we spent a considerable amount of time wondering how the USDA would adjust their acreage numbers, adjust this and that. And as we saw, they were pretty reticent to change anything. So I think, the lesson I learned out of that is that what we need to know going forward when we get the acreage report and these other reports, we need to know what the USDA is thinking ahead of time, so that we're not trying to outguess them and try to put upon those reports what we think ought to be there. We need to know what they're thinking, because when that data comes out into the market, it's responded to as quote the truth by and large, and the markets follow what the USDA is thinking. So if the USDA right now is talking about 97 million acres, even though in my own thinking I would not be surprised if farmers scale back on that, we need to know what the USDA is thinking as they go forward, particularly now to that acreage report heading off into the latter part of June. Estimated 2020 production, if we have a large crop, in the Outlook conference in February, the USDA came out, projected over 15 billion bushels of corn. And if we had great use, well, that wouldn't be any big thing. But if you have 15 plus billion bushels of corn, and you end up likely with a 2 to 2.5 billion bushel plus ending stocks figure, 18% stocks to use. The USDA projected earlier in that Outlook conference about 360 prices. I'll show you a graphic here later where that all else being equal, as economists say, ceteris paribus, if we really get 18 to 20% stocks to use, the price is probably, that 360 price is probably generous. We're looking at something closer to, something 20, 30 cents below that if we follow historic approaches. Just want to hit some things quickly. Futures and cash prices, looking at the top cash prices in western Kansas and eastern and central. We've fallen off. You can see the darkest blue line would be the lead futures contract, and we're down for those contracts to 330. I think 334 or thereabouts was the close on today's market, and that's fallen below where we were when markets had fallen off last summer in August. So you can see that as it is. Note that the Western Kansas cash prices are above the futures. It's right now, when we're so wondering about what the what might happen in terms of the of USDA numbers. Well, we have to look to the cash prices and the basis to get some clue. It's interesting, in Western Kansas, Garden City Co-op, we still have a very healthy basis. Glenn probably has something to do with livestock feeding numbers out there, along with some ethanol plants. But when you come and look at the figures in Salina area, much more of a more ethanol plants, more of an export-oriented area, basis there has fallen off. So just by area of the state, we're seeing a little bit of separation. Corn planted areas, we can come back and talk on this some more if you'd like. Note that the number in Kansas for corn plantings, 6.3 million acres, down 1.6%, basically down 100,000 acres. And big issue, of course, on everybody's mind, it would be that the ethanol profitability issue and how that big chunk of usage, 5.425 billion bushels of corn projected to be used, how that thing would be affected. Here at KSU, we try to stay up on those numbers to see how plant profitability is going. And by my estimates, particularly because of ethanol prices falling off so harshly, we've got a cost reduction in March about $1.45, which is not an exorbitant amount. The price fell off to about $1.02 for ethanol, and so do the math. We're losing about 43 cents. That's the largest loss that I have following these records. DDG prices have come up, and that helps, but not enough to offset that big drop in ethanol prices. Corn stocks to use. Again, we talked about the ceteris paribus, all else being equal. It looks like the 360 projection, if the markets were accurately calibrated, and we have no reason to doubt that they weren't through 2017, 18, 19, then so if you see at 15, 14.5, 13% stocks to use for the U.S., we ended up at 360. Pardon me, about 336, 361, 385. You jump up the ending stocks to use. It looks like that 360 price USDA put out is probably on the high. Well, you would think, all else being equal, that would be a high number, and we'd be more likely to see something at 336. If you just followed this, it'd be more like 320, 330 thereabouts. So that's at least my own opinion that I defend. I do want to bring up something to you. When you look at the World-less-China versus world corn stocks to use, you have a situation where when these aggregate numbers come out, you see that world aggregate stocks of corn 2019-20 marketing year, 297 million bushels, million metric tons, and stocks to use 26%. If you take China out, just one country, China, with their large stock holdings, then world stocks drop. World stocks minus China, 98 million metric tons, 1/3 that amount basically, and stocks to use at 11%. compare that back to 2012 when markets were so hot because of a drought in the U.S. We were at 64 million metric tons empty stocks in the world, and about 9% stocks use. So vastly different picture if you look at the world with and without China involved. Want to take a quick look at sorghum markets.
Hey, Dan,
yeah.
real quick, this is Brian. Chime in. There's some questions that are coming up on the chat, and maybe just go ahead and address them right now if that's okay with you.
Yes, I need to show my chat thing here. Excuse me. Okay.
Either I could read them to you, or if you want to pull it up.
Okay. Let's see. Well,
you might read.
Why don't you go and read them off to me, Brian? That'd be good.
Okay. So from Daryl, it says, by your estimation, net of DDGS and oil, how close are ethanol plants to covering variable costs?
Well, I can figure that. And well, let me tell you where I'm going. I use a model out of Iowa State University off the ISU Ag Research Center site. My mentor at ISU, Bob Wisner, helped put that thing together. And the fixed costs are, well, if there's one measure of fixed costs, fixed versus variable, we kept operating without any problem at 25-cent losses. You know, we heard of no plant closures. Now we've dropped down to, and that was in January, February. Here now in March, we dropped to 43 and we're closing them. So somewhere around that 25-cent loss area, you know, just by implicitly by the actions of the market, by that industry, we've breached down below the variable cost. So that'd be a quick and dirty way to look at it. I think whatever that number is at, 43%'s has gotten into the territory where we're not covering variable anymore.
Okay. Another question from Dan is, could USDA curb excessive corn acreage by making prevented planting claims easier, such pulling forward the cutoff dates for filing such claims?
I'd have to think on that one, and probably ask Michael, and probably the person we need here is Robin Reed. Flexibility would no doubt help. It's just a matter of how they would do it. And that's prevented planting claims for the coming year, or is that what they're after? Let's come back to that later if we can. I think I need to give a better answer than that.
Okay, sure. And Michael can maybe look into it a little bit too when we circle back at the end. Another one from Josh is that with lower ethanol production, do you believe we will see increased corn usage and livestock rations to offset reduced distiller supplies? And if so, could that increased usage move the needle somewhat and increase corn demand even slightly?
Yes, someone I try to follow and stay in touch with, quasi friend Alan Brugler. I was listening to his approach and take on this. He had about it was about a 30% substitution. Yes, if we take when we cut back on ethanol production by X amount of bushels of corn, then we're bringing out say 200 million bushels of corn, and that would reduce usage. We're having the equivalent impact on the backside of about 70 million bushels of corn that we'll have to use to feed to replace lost DDG usage. So that's about a 30% substitution. So could move the needle. Again, so is it 200 million bushels less corn usage? Is it 4? Is it 6? If you use that type of ration, then if it's 600 million bushels, then you're looking at 210. So 600 million bushels less of corn usage in ethanol, plus about 210 million bushels more of corn feed usage. Again, all else being equal.
And here's another question. I think it kind of pulls us into the sorghum markets a little bit too. It just says, how many of those 6.3 million corn acres will be planted as sorghum or soybeans? Have that in your key points here when you're talking about the sorghum market.
Yeah, well, we're coming to sorghum. That's next. There's a number identified for the U.S. and for Kansas. I think what's implicit there in that as I perceive it, is that we'll have people bailing out of corn acres, and they'll go to something else. So again, is it sorghum? Is it soybeans? Who knows what? Well, I think. Well, I would say I don't know the exact answer to that. I do think that there's right now, if people are raising the question, then they're considering doing it. We're almost getting back to the issue of how much seed's been bought. How locked in are people with their corn? They can still make money on corn if they have a tremendous yield year. Of course, if everybody has a tremendous yield year, we're going to sink the market. But individually, they still make those decisions. So I guess I don't want to be a swashbuckler and predict too much of an acreage shift quite yet until we see how the next. Well, here we're April 1. I guess by the time we get to May 1, we'll have a better feel for what people have actually done and they start switching seed around or not.
Sounds good. Go ahead and keep moving on.
By the way, I did figure out how to get that Zoom chat up, and I see a couple more questions, and we'll try to from Dan Mandernack and Louise Emke, and we'll come back at those later on if that's okay. Ethanol sorghum use, same risk as corn. Loss of 10 to 25% of sorghum use. That's 105 million bushels, so 11.25 million. Of course, that would pressure sorghum prices on its own. Planting prospects. Again, projected to be about 5.825 million acres of sorghum, and that's up from about 5.26 last year, about 5.7 the year before. We do have some Chinese export interest in grain sorghum. In the last about 2 weeks ago. Suddenly, forward purchases of grain sorghum jumped about 20 million bushels, and in the last report that came out, actual shipments jumped 10. So things are starting to happen, and if you're in the grain sorghum industry, you're saying hallelujah. Why did it take this long? But so anyway, and you do see the basis shows that this is happening at the grain terminals. So the USDA's projections that came out of the Outlook meeting in February, $3 USDA numbers. When we have grain sorghum tapping into that specialized market to China in particular, then for that aspect of its supply demand, it separates itself from corn. So I'm more optimistic on grain sorghum prices, given that this door is open right now, than the USDA is. And you can see just here on the basis levels at Garden City and at Salina, again off of our ag manager site. Michael and Rich shepherd that. Wow, we don't see movements like this unless you have elevators that are anxious to get hold of grain sorghum and have a place for it to go. So we have some quote confirmation in the country that this is happening. Grain sorghum exports, you can just see that they've been on the low side until just the last bit of time. So that's what I guess a 10 million bushel week looks like on a chart like this. Is any other questions on grain sorghum? Okay, I don't see any at the moment, so let's move on and we'll come back to those. Let's talk about soybeans. Strong U.S. soybean meal markets, and there's a factor here that I think in our frustration with what's happened to the commodities, there's some issues that we shouldn't ignore, and that's that the COVID-19 and other government policies are impacting some of these other countries. If COVID-19, government tax trade disruptions in in Argentina, some reduction happening in the 2020 Brazil crop, the size of their soybean crop in the southern part of their growing area. And I want to come back to that at the end in terms of what factors that we're not really focusing in on yet that could surprise us in the grain markets. 2020 U.S. soybean prospects, USDA projected 83.5 million. The market came in projected about 84 to 87. Here's the way I view USDA planting numbers. I see what we've done. We probably have bought seed for this. That was our expectation. The first 2 weeks in March, a lot of dynamic changes all happening. But as you go forward, our success of being able to plant corn is going to have a lot to do with what we end up for soybeans. We found that last year. We just had too much moisture. Estimated 2020 production ending stocks, 4.2, 4.4 billion bushels. If you get that, that's basically a return towards normal. If you have a large crop, ending stocks 300 to 450 million bushels, not 900 like a year or so ago, but 7 to 10% stocks to use. Season average corn price about where we're hanging out at, about 850 to 880, with the caveat that these ports in South America and their distribution system isn't damaged logistically by what's going on with the COVID-19 disruptions. In Argentina, their towns are stopping truckers with weapons. They don't want to pass through because they think they're getting infected by them. In Brazil, the head of the country said, "Well, we're going to go with the herd deal," and Brazilian. So basically, a very laissez-faire approach. Well, I think we should not be unaware that as this disease has affected a lot of places, it could impact the logistics of these other countries. Okay, soybean futures. I just want to hit on that quick. Up and down, you can see some movements. Where we've fallen to now is about for future. The futures are below where we were last summer when we fallen down, but the cash prices with a little narrower basis are just now getting there. Basis levels still not too bad. Interesting that Cargill and Salina, export-oriented place, pretty strong basis levels. So that's something to watch. Soybean planted area, again, we could talk about this later. Basically in Kansas, we're planting 5 million acres of soybeans by that prospective planting report, and that is up about 450,000 acres, about 10%. Exports running along at an okay pace. Again, my caveat on this is that if there are problems down in the southern hemisphere, this could change pretty dramatically. So just as I've made the statement for corn that everything else being equal, the corn price looks low. Everything else being equal, if the USDA is right, the soybean price looks low. Only moderate changes in the price and dramatic drop off in stocks. So something's going to have to give there. World-less-China, again, you can see that China holds some stocks, but it's not near as much of an issue as for corn. I want to finish up on wheat. There's a question, from Dennis and Jamie, what should we do with last year's corn? Sell it or hold a little longer? Does it look like time to sell or hold on a little longer on grain sorghum we got from last year's crop? Well, I will give you my take on this. Do we still hold out hope for seasonality or not? It seems like the time when you look at the average pattern of Kansas corn and grain sorghum prices, we go flat. We get to March. We get to March. March and April, we go flat until we get into May and June. So that said, with all the headwinds that are being faced here in this market right now, we have less. I think we have less confidence that that's going to happen. All that said, though, so I cannot tell you what to do, but I think there will be issues of seasonality that we'll still have to deal with, and at least some hope for some return to holding grain out into that time frame. And like I say, we're put into a real gambler's mode right now on these things because of the uncertainty, and we're discounting opportunities out in the future because of all the unknowns. So right now, when you look at the market, it's pretty pessimistic about things, and that may or may not prove to be true. So you asked me a straightforward question. I danced around it 3 times. I'm sorry I couldn't be more straightforward, but I would still trust there'd be some seasonality with planting uncertainty, et cetera, things that we're not even, those issues that we're not even thinking about at this time. Let's finish up on wheat. Strong domestic milling demand for U.S. wheat. U.S. consumers' risk-averse response to COVID-19. Toilet paper, bread, and meat off the counter. Those are things you couldn't get in the stores. As the pandemic continues, likely strong domestic use also will, as long as people are worried about having adequate supplies of those. Wheat planting prospects, just a so-so situation. A little bit lower for hard red winter wheat, a little bit lower for spring wheat. Probably with these high prices, though, less abandonment, less graze out with the higher wheat prices. That's kind of the marginal deal we've got. Estimated production and stocks, if good yields, production 1.8 to 1.82 to 1.85 billion. Ending stocks 777, 36% stocks to use. You know what? That number doesn't have a 1 billion in front of it, and the accumulated impact of lower acres and at least a moderately strong usage, decent exports are tightening us up. And average price, USDA's projected 490, if we really attain these levels, then you'd see a higher price. By nature of where we've been in the past and how prices have responded. Hard red winter wheat futures, you can see really pretty strong now. Last couple of days has been lower again, but wheat has been really kind of the star of the show in terms of the commodities, and much higher than where we were last summer when we were pessimistic. Note that basis levels doing okay, not skyrocketing. In a way, probably the futures were doing the skyrocketing instead of the basis on this one. And you can see the long-term trend in that upper corner up in here in terms of where our acreage trends are. And winter wheat figures, again, 6.8 million acres. That's down. It continues the 200 to 300 million acre per year downward trend we've got in Kansas for winter wheat. Exports, pretty good for winter wheat, towards the high side of what we've seen the last several years. For hard red, okay, pretty strong. It's not as low as it's been. So all that's somewhat of an encouragement on the wheat market. In terms of where we're going, again, note the trailing off of stocks to use, 55, 53, 43, 36 projected for the next several years. Prices holding up decently. So right now, wheat's holding up price-wise in terms of in the USDA's view as well as anything. And I just want to show you two more graphs. So what is the supply demand in the world wheat market? Again, you have a with China and without China view. With China involved, man, we're just awash in wheat. 38% stocks to use, 288 million metric tons. You take China out with their large stocks, we're the tightest we've been since about back in 2013, 14, 140 million metric tons, 138, 140 last couple of years, 23% stocks to use. We're basically equal to where we were in 2012. So we've been talking about this for a while in terms of what's really available on the wheat market. Well, we're pretty tight, and the aggregate numbers don't seem to be telling the story. It seems like we need to be looking at what's actually on the market, and with that, we're having some better prices. Want to finish up. COVID-19 economic impacts may go both ways. So while the U.S. grain industry is hurt, so may be other countries as well. And again, we're watching South America with their logistical issues. We've got other countries at play that could be affected. I just think going forward that if we can maintain our distribution system in an uninterrupted manner, that'll be an advantage. It'll give us the opportunity to meet export needs down the road. Brazil and Argentina using mixed strategies. I've already talked about that some. So you can already sense my pessimism as to whether they'll be effective or not. If they're not, then those are, you hate to say it's an opportunity, but we should be ready in case it presents an opportunity for us. Some strength in consumer food demand, some strength, because I don't want to rain on the parade of my livestock brethren. People's risk aversion effects could yet periodically surge. That's a polite word for panicky buying. We don't know what lies ahead the next several weeks, and when that happens, it's probably helping wheat. If this recession in the U.S. world has a quick recovery, then I think you asked the question, what will be left? What position will the U.S. ethanol industry be in if we lose, or if their financial damage to 5%, 10% of that industry in a downtime, that would be pretty rough. Value of the dollar, that seems, unless things really change, that's gonna be a headwind against us on trade. And probably the big question: what permanent changes will this cause the U.S. economy, and for U.S. and world ag policies, production, logistics, stocks? My first intuition on that is that people will probably be more protective. And I sure invite your thoughts and discussion on that. But when people get worried about having adequate domestic supplies, they tend to invest in stockpiles. And to the degree that happens, that kind of gums up the world grain markets in terms of trade anyway.
All right. Talk about oil prices, since Dan kind of alluded to that. It's been more than just a COVID thing going on. There's really been kind of a war between Russia and Saudi Arabia for that. So as a result, our oil price has gone down to $25, under $20 right now. But really some background for this, before we became a leader in the oil production thanks to fracking, $4 gasoline was not out of the world for us. That was pretty common. But then we developed fracking technology here in the United States. And since then, oil has held pretty steady in that $50 to $60 range. We've become a world leader in oil production, and that has really kind of crippled OPEC. As a result, OPEC now has kind of reformed. And I hear the new terminology for it called OPEC Plus, which really is the old OPEC, and they added Russia to the deal now too. So what has been keeping the oil price in that $50 to $60 range is that Saudi Arabia and Russia have kind of agreed to cut production whenever demand has dropped off, and they've kept production right at that $50 to $60 range, which has been pretty good for the U.S. producers in the U.S. because while we are a higher cost producer of oil, they can make a little bit of money at that. Certainly not getting rich, but they were able to stay in business at that rate. Well, with the COVID thing going on, that has reduced demand. I've heard it has reduced oil demand by about a third across the United States. So Saudi Arabia, when this first started to happen, they got together with Russia, and they tried to get Russia to agree to cut back on production like they have in the past. Russia didn't want to do that. So what the Saudis did to counter Russia then was they decided they were going to amp up production, thinking that would kind of force Russia to cave. That actually didn't happen because Putin decided, well, I'm going to ramp up production as well here. So now we have both the Saudis ramping up production and the Russians ramping up production. So we've really been flooding the market with oil. So not only has demand dropped off tremendously, but we've been really supplying the world with extra oil thanks to those two countries. And the result is what you see on oil price. It has gone down really below $20 per barrel last week. Now, just today, this is a very volatile market. There was some talk that they might try to end that war between Russia and Saudi Arabia. So oil jumped back up to about $30 today, but we'll see if that actually takes hold or not. So if they don't put an end to this, $20 oil could be here for the next few months or so. There's also been some talk that Russia did this not only to get back at Saudi Arabia, but they did that to get back at the United States as a way to kind of cripple our fracking industry. And if that was the case, I think really Russia has been kind of successful doing that, because just today, Whiting Petroleum announced bankruptcy, and they're one of the big players in the North Dakota oil basin here. And really the entire fracking industry is on the verge of really kind of going bankrupt, because a lot of them have a lot of high debt level. I've read today that there's $32 billion of debt that's in debt jeopardy here, thanks to a lot of high debt ratios for a lot of these companies here. So this is not a good thing. At $20 oil, you may think that's great, but in reality, that's very bad for everybody. No one's making any money at that price point. Well, what has caused that to happen then is, at least temporarily, we're going to see some good gas and diesel prices here. So the graph on the right, you can see what the trend line is based on what the oil price is. There's a very high correlation between the price of oil and the price of both gas and diesel fuel. For gasoline, it's a really high correlation. It's like in the 90% range. Diesel is not quite as good, but it's still like about 0.85 or somewhere like that. So really, based on what we have seen for the oil price, again, I had to actually readjust this graph, because we're at a price point now where my graph was actually, it didn't go that low. So $20 oil, I'm not sure when the last time we have seen $20 oil was. It has to go back a long time. So last week it was about 19. If you look at my graph there, that would say that really we should be looking at about $2 for road highway diesel fuel price, and about $1, probably about $1.75 or so on the gasoline price. So we're not quite there yet. You can see I have the last 3 points marked there for the diesel fuel price. It's about 50 cents above that trend line. I don't think the market has had enough time to adjust yet here. So I really expect to see the diesel fuel price and the gas price decline over the next month or so if oil stays within that $20 to $30 price range here. So potentially, I think we could see about a 50-cent price reduction in diesel fuel yet, unless Russia and Saudi Arabia do actually end the price war. Gas probably could go another 30-cent lower yet, so a gallon lower yet. And you've probably been seeing that at the gas pump here as these things have been trending lower here. So, potentially by the first part of summer, gas could actually be another 30-cent lower, while diesel fuel is another 50-cent lower. We'll just have to wait and see. Again, this whole thing is very volatile. A lot of moving parts to the whole thing going on here. So that's kind of what's going on in the oil market. Dan, if you could kind of go to the next slide there. Now, one thing the low oil price could be a benefit for is on the fertilizer side. So, natural gas is one of the key components to producing nitrogen fertilizer. I found, though, modeling this, so that the price of oil really is a better predictor of what the fertilizer price is than what the natural gas price is. So the fact that we have a lot lower oil prices now, really about 7 to 9 months from now, that should translate into much lower fertilizer prices. So it probably won't do you a whole lot of good. I'm sure a lot of you guys probably already have your fertilizer already booked for the spring. But I would say probably by next October, we ought to be looking at a lot lower fertilizer prices coming for next year. So that's one benefit. Now, saying that, though, fertilizer is a lot lower than what it was last year. So DAP and MAP and anhydrous all are about $100 a ton lower than what they were at this time last year. I would, again, expect to see fertilizers move lower all through the summer and into next fall, assuming we don't kind of get this virus thing under control and there's no more disruptions and things like that. One thing to keep an eye on, though, with the fertilizer side of things is supply considerations for China, because China is one of the world leaders when it comes to phosphorus fertilizer production. So things like DAP and MAP, China is one of the world leaders for supplying that. That is actually one of those two fertilizers are actually one of the things we import quite a bit here in the United States of DAP and MAP. So right now, just looking at the prices, it doesn't look like the supply issue is such a big deal for DAP and MAP. Supposedly China was down for a couple of months with their virus problem, and they weren't making a whole lot of fertilizer then, so it doesn't appear to affect a whole lot of things here. And if they are back up to production, that probably shouldn't be an issue. But just keep an eye on DAP and MAP if you need it this spring. That if you do need it, I would probably go ahead and get it right away, just to avoid the possibility that maybe it could run out sometime in the future. Looking at the seed side of things, that really shouldn't be an issue because practically all of our seeds are produced here in the U.S. There should be probably plenty of corn, soybeans, because those seeds can be kind of carried over from year to year if we don't get it all sold in one year. If there is a switch in the amount of corn soybean ratio, those kind of things planted, the seed companies may have to move some seed back and forth across the country potentially to kind of allow for those kind of things. But the overall supply of seed, I don't think should be a problem. If there is a big ramp up in soybeans, though, soybean is one of those seeds that we really can't carry over. It's just the seed you plant is really the seed that was grown the previous fall. So if we do have a big increase in soybean acres, potentially, soybean seed could be a thing that's really kind of hard to come by here potentially, although I don't really see that happening right away either. On the chemical side of things, China is really a big source of a lot of the generic products. I think a lot of the generic Roundup glyphosate comes from China. They were down for a couple months with production here, so I don't know if that's going to be a problem getting those kind of things in. I haven't heard of any kind of stories right now. As Brian mentioned last week, I think currently right now there seems to be plenty amount of supply, but going further into the planting season, that may be something to keep in mind, is that again, China is going to be a big producer of our generic products. On the labor side, I'm sure you guys may have all seen the initial jobless claims that came out again this week. As Brian showed you last week, it was really bad. Well, this week was, take that factor and doubled again. It was like 6.6 million initial claims. So there's plenty of labor out there, people looking for work. I don't really see labor being an issue. I always go back and look at the Spanish flu. Now, again, during the Spanish flu, labor was a big issue, but again, agriculture was a lot different then. There was a lot more hand labor, people involved with that. There was people sick with the flu and the World War I going on. That labor was a factor back then. A lot of the crops didn't get harvested during the Spanish flu years. So I don't really see that being a problem this year unless this thing becomes really bad. But assuming we are maybe at the peak of this virus, labor issues really shouldn't be a problem going forward. So that's kind of all I have right now. Dan?
Yes.
Just do questions. Dan, you can get back on, but the rest of you can go ahead and just put your video on and make yourselves available. Folks, we'll take questions on the chat, not just for the grain markets here and those things, but we have a livestock specialist. We have a macroeconomy specialist. We have Michael Taylor with a number of things there, land values, and among other things, which she'll be presenting on. So go ahead and put your questions in there. There was a question earlier, and I'm not sure if we got to it from Dennis. What should we do with last year's corn? Dan, this looks like for you. What should we do with last year's corn? Sell it or hold it a little longer? Does it look like a time to sell or hold on a little longer on the grain sorghum we have of last year's crop?
If it's grain sorghum and exports are starting to go forth, and again, you're weighing the possibilities. Here we've had some export business now. The chances are there's a better chance of grain sorghum benefiting from that. So for grain sorghum, there's a likelihood of prices increasing in response to that. And again, you'd seen the basis is reflecting that. So for grain sorghum, it's as you weigh the possibilities to hold out to hold in a speculative manner for prices to go up is not too bad. It is a better proposition than for some other crops. For corn, we're in such a trough right now with regard to positive news, and especially until the ethanol situation rights itself. And when will that be? If we're done with the economy's struggles or have mitigated it some, heading off into summer driving season, then there's a response back. But it's really an iffy thing right now to see when that would happen. We'd have to basically, we're kind of relying on a planning problem, to bring corn prices higher now, and unless or until the ethanol situation rights itself.
Dan, another one I think for you, is there any talk of dropping the ethanol requirement in fuel since the wholesale price of gasoline is now less than that of ethanol on an energy basis?
Not if the Renewable Fuels Association has anything to say about it. That would be the hottest of hot potatoes right now. Really, that's kind of the line of defense for the ethanol industry, is that requirement of the renewable fuels standard. So I have not heard of that. I don't want to belittle that question. It's a fair question, but I guess I don't see it happening unless we have such a catastrophe economy-wise that all those things, even those type of commitments to the ethanol industry, are on the table. So I guess I don't see it happening, at least with what I could foresee.
And Michael, there's a question from Shelley Yeager here. What are we looking at on cash rents? If we see corn prices decline to Dan's estimate, could we see rental rates become more flexible?
Yeah, so that's a great question. I think what we're looking at there is the need to work with your landowner and get them as aware as possible of what the situation is. So if your landowner isn't watching webinars like the one that Dan just is doing right now, or even the one that we're going to do on land values, we'll talk about rental rates a little bit as well in 2 weeks. So that they know the situation, so that when you talk to them about potentially dropping rents, they're going to be open to that idea that, oh, okay, I know the situation and I understand what's going on. I always harp, of course, on communication, but it's really important right now that you share with them as much as possible what's going on, so that they don't that they understand why you might be asking for lower rents. I think the other thing to keep in mind is that for a lot of landowners, they're not going to be willing to go below property tax rates. And so there's going to be a floor on those rents, which is going to be helping them cover property taxes. So that's something in some areas of the state that we're getting to the point where what we can afford to pay is in and around what we need to be able to pay in order to just cover property taxes. But my advice there is get them to log in for these kinds of webinars, point them to Ag Manager, talk to them about what's going on, and try to share that information so that you can have a good conversation with them about potentially lowering rents.
Glenn, here's one on livestock. Randy visited with a client today. The client had bought a set of feeders 2.5 weeks ago, needs to buy more. But since there's already been a substantial drop in the price since, he's already losing money on what he bought. He is wondering if should I buy more if things get even worse in the summer?
So the broad reaction is the concept of dollar cost averaging applies. If you're buying assets repeatedly, if the price goes down, that helps you if things recover afterwards. So if you're staging out, making multiple purchases over a period of time, which could work for somebody that's still buying feeder cattle, then that might make sense. My biggest word of caution would be, Greg made the comment about not hyper concerned about labor. I hope he's right. I'm not as convinced of that in the livestock space, particularly because of the bottleneck at the packer processor level. I anticipate by the time that we do this webinar a week from today, when I'm slated to lead the presentation, that we will have several plants that are running at partial speed, not full speed. And why am I noting that? That quickly decreases demand for live cattle and therefore feeder cattle. And we're seeing that on the board. The board is down hard today. That spills over to Dan's comments about crop demand. I mean, these are all interrelated. We know that. So in principle, yes, it makes sense to buy cheap and pull down your average purchase price is what you do if you're in the process of buying feeder cattle. But I think it's premature to say we're at the bottom of feeder cattle prices is what I'm trying to allude to there.
Thanks. For Michael again, from John, I'm sure we'll talk about this in 2 weeks, but if land rents go down, won't land prices drop as well?
So in the long run, if rents go down, land values will respond to that, because people will see the profitability in ag land being lower. I think for the short run that we're worried about land values, we've got to look more at supply of land for sale right now and see that that's where that's holding in order to keep land values up. But I'm not worried about, some short-term adjustments to rental rates affecting land values. I would be more worried about that as a long-run phenomenon. What I'm looking at right now for short-term land values is supply, and also the willingness to bid on ground given liquidity constraints by farmers.
Rich, there was a question from Louise Emke about, I believe she was referring to market facilitation payments.
I missed that.
I think, Louise, I think it has to, I think whether those payments come or not will have a lot to do with the depth of the trough in the ag economy. And it is an election year, and it's there are politics involved. More likelihood of that happening in an election year than not. So I would not be surprised, but the recovery of the ag economy heading into summer, whether it does or not, tied in with the overall economy, probably will be the driver.
Thanks, Dan. I'm glad you caught that. From Dan, the question is, does blame for COVID make China more or less likely to honor phase 1 U.S. import commitments, imports into China?
And what does what for COVID?
Does the blame for COVID
blame
make China more likely or less likely to honor phase 1 U.S. import commitments? There were some reports yesterday, I think it was, that came out that they hadn't been very open with some of the information. Will that make, it's some of the political issues going on. Does that make them more or less likely to honor phase 1 of the agreement?
Dan, I'll jump in for you.
I have an answer, probably not. But how do I say that?
Well, part of me says the quote-unquote blame over COVID is not as relevant as some might think it is. I'll remind everybody that China still has a quote-unquote protein gap. The African swine fever situation that was not being talked about, because we're all talking about COVID now, is real. And if the Chinese economy is truly recovering, and notice how I said that because I don't think we know for sure yet, then there's going to be import demand from China. How much that's mitigated by political gains is to be determined, but I don't think you can ignore the protein gap that exists in really all of Asia.
When it's a trade 1-to-1, but it's doesn't matter. It's when it's even between us and other suppliers. Ill feelings will probably make them go the other way. But if they're desperate for supplies, they'll go to get their supplies.
Well, and go further, those import prices have come down notably in the last month. Doesn't matter what commodity we're talking about. So, except maybe wheat a little bit, but on balance, they would be importing more and cheaper than they would have a month ago. So.
Yep.
One other thing I would add in here to be thinking about, especially for the farmers, ranchers, agribusiness folks that are on the call, there are some application deadlines that are going to start coming out actually tomorrow regarding part of the stimulus package for loans, and even some of those loans that could be forgiven. And I've been having some conversations with some of the farmer co-op community in particular on the Paycheck Protection Program. So tomorrow I'm going to, with Rich, do a Zoom session quick interview to talk about, well, what's all in that program as well as other programs for farmers and ranchers. I do know there's some items in there too for farmer co-ops. So just a little plug that there'll be some more information coming out on that. But it's certainly something that many producers, especially those who have employees, might want to look into getting a loan from the Small Business Administration or an approved lender. So we'll have a bit of a discussion on that tomorrow.
Thanks, Brian.
And that'll be available on, we'll post that on Ag Manager once we do that conference discussion.
That'll be up tomorrow afternoon along with the video for tonight. We have a question, and Dan is clarifying it. It's from Louise. Louise, could you just clarify, do you mean quantity sold, or is it high prices? I'm assuming maybe it's not historically high prices, so maybe you mean the quantity that's being sold. Yeah, many acres, she says. So the question, in West Central Kansas, we're seeing land offered for sale at historic quantity levels. Why is that? And will more land keep coming on the market?
Well, the story that I've been getting from a lot of people is not like we're tracking bankruptcies, and the bankruptcies are still they're up, but they're not spiking. And so I think what's going on is more of a piecemeal letting go of a piece of land in order to get ahead of debt and or restructure debt. And so you start having enough people put together pieces of ground that they're wanting to put up for sale, and then at some point it's going to affect the price of land. Will we see more land keep coming on the market? That remains to be seen as far as profitability this coming year. The bankers certainly have a pretty significant chunk of their portfolio that they're worried about, and I think that we can only take so many years with low cash flows and having problems with liquidity that we are going before we start running into problems where we're going to have to start selling off land. And in local markets, you can't sell off too many pieces of land before you affect the supply. And once you affect the supply, then it's a little bit hard in a land market to say, well, is it a supply driven response or is it a demand driven response when you see prices change? But the argument across the Midwest has been that we haven't had enough land to go up for sale to push prices down. That's why prices have remained relatively flat across the Midwest and the Great Plains. Now we're seeing ground start to drop a few percentage points from last year, and that means that we're probably seeing a bigger supply of ground for sale. We've got, I want to talk about Lucas. So Lucas saying some ground going up for sale by less favorable CRP re-enrollment terms. That's a great point. I think that, so we dropped the CRP rental rates in order to make them competitive with market rental rates because they were so high. We tried to make the CRP rental rates really high to make sure that we didn't lose CRP ground during the boom years. And then as we've come out of that, they've wanted to drop the CRP rental rates to make them more in line with market. And for a lot of people, though, they're not good. They're not terribly good CRP rental rates, and or in some counties we've been seeing, and this is actually in north central Kansas, where we've seen people not able to get re-enrolled in CRP because of the acreage restrictions. And so for someone that's a retired farmer, maybe living in a retirement home, they don't have their own equipment, they'd have to either rent it out or sell it. They're probably looking to sell it and see if they can get a decent price for it rather than trying to rent it out and be a landowner again.
Folks, go ahead. We've got time here, and we've got folks on to answer the questions. So if you've got them, go ahead and put them in here. Do any of you, Greg, Dan, Glenn, Brian, Michael, do any of you have any additional comments that you thought of as you're sitting there?
Well, I thought in fact, I spoke with Lucas about this afternoon here. I've not heard anybody in the ag sector say that because of logistical, transportation, handling issues that they've had any problems getting seed or fertilizer or parts or anything. So that's a great comfort. If those things start to creep in, that could hinder planting, and that to some degree, to the degree that it's an intensive, widespread issue, then then you're looking at you're probably pushing corn acreage back into soybeans all that much more. So if any of you have heard of that happening, please let us know. But I have heard of nothing along those lines yet.
We did have a question from Steve. How big of an issue is prevented planting in 2020?
Well, I'll try to. My good friend, Frank Olson, from North Dakota, and has not indicated major problems yet. And some of that land was soaked. We've had some dry conditions in those areas the last few weeks, so perhaps that's mitigating some of that. But if it's mucky or rainy at all up in those areas that were so wet and so soaked, that's where I see it, where it would expect to see it happening first, but haven't yet. Of course, it's early.
Glenn, there's a question for you. Could you elaborate more on what the impacts could be if several packing plants start to run at partial speeds next week?
So, Ben, what I anticipate to happen there is subsequently meat price gets more expensive and livestock prices decline, because effectively we're going to reduce the demand for live animals to the extent that we reduce operating capacity. The concern is a bigger version of what happened in the Holcomb plant fire back in August outside of Garden City. That was one, albeit it's a big plant, but that was one plant. The concern on the market right now is multiple plants, multiple species across the country may end up running, one shift instead of two, or idling certain days, or different things to increase cleaning time and to protect their workers. And if that occurs, we will have less throughput through those plants. Many of those plants run double shifts, 5 days, and then weekends. So anything that pulls off of that reduces the ability to handle animals. Go further with that, we start getting heavier weights. Cattle weights are already up from last year and so forth. So there's multiple reasons to be concerned about that. That's why I was politely pushing back on Greg's comment. I agree with Greg from a crop perspective, and I actually agree with Dan that on balance, people have been able to get hold of their inputs, and that's all great. I just think informally, and I will tell you informally, I'm being told, we're going to learn before you get to hear from me next Thursday that some plants are being slowed. I hope not stopped, but slowed. So you're going to see some of those effects.
Last call. There we are. Thanks, Brett. What are the long-term impacts of the slowing of the packing plants? So I guess he's thinking more longer term than the short term.
That's hard to comment on because it depends on how long it occurs. I mean, if that happened just for 3 days or something, I don't know how big of a deal that is. But if we have to slow them for a month or something like that, you put large downward pressure on prices on anybody trying to sell live animals. So whether that's fed cattle or market hogs or broilers, again, it's a little bit to be determined which of those species is hit the most there. It puts massive downward pressure on the profitability of anybody's trying to sell those animals. So you'll shrink the supply in the long term because you're putting a profit squeeze on those that are trying to sell animals in that example. It will also beg into question, how do I want to say this? There's large economies of scale in packing plants. We have a small number that are very big, and we run lots of animals through them. The reason for that is to spread those fixed costs across lots of animals. And under normal operations, that makes lots of sense. But it also makes an industry susceptible to black swan events. I would argue we're in the midst of a black swan event. So the infrastructure has bottlenecks, and the packing plant component in many ways is a bottleneck for the meat sector. So that would also be a long-term impact. That structure of the industry, I think, would get talked about more if this becomes bad over the next couple of weeks.
Anything else while we're here? Well, I'm not seeing anything come. Whoops, here we are from Glenn. Oh, it's to Dan. If consumer demand for meat stays strong in light of plant slaughter cutbacks, what happens to grocery prices?
So, well, you're going to give me an if, and I'm going to push back even on the if. I'm not convinced that aggregate meat demand is strong and will grow. We definitely had a massive shift from food service over to retail, and we're having a decline on the export front, at least in the near term, for logistic reasons of quarantines, the concerns about protectionism, where some people are going to, not import and export food the same, and all that kind of stuff. I'm not convinced that we have growing meat demand overall. I think we had a surge that we saw, particularly on ground beef and a few other products. If you break apart the cutout, the primals, the part of the cutout that give us ground beef, spiked notably over the last couple of weeks, much more than other products. So we're not seeing across the board growth in demand. It's largely a hoarding tied to ground beef in my freezer at home. I hope that there's renewed demand that goes beyond that, But my massive concern is that we have adverse demand because we have adverse macroeconomic conditions to boot, and then we have the supply concerns. So yes, that's Dr. Bear giving you a long answer. It would take really positive developments for us to have a net positive meat demand situation 3 weeks from now compared to what we have at the moment.
And related, Glenn, is the packing plant speed reduction demand related or just about worker safety?
Yes. So the packing segment, again, this is informally, I'm being told they had past orders, obviously from restaurants that have fell through, but previous requests from the retail sector to hurry up and fill the supply chain, some of those are being waned, right? So they're getting the signal we don't need as much for the retail side either, which to me is code for a lot of people filled their freezer. So grocery stores aren't chasing it as much as they were maybe 10 days ago. So that is a demand signal within the chain that we don't need the meat as much, right? The packers are hearing. And then you've got the worker safety and or in some states, maybe they'll be required once there's certain tests to do something different. So there's a whole bunch of things that are likely going to restrict the ability to run those plants the same as we did a month ago.
And a question here, do you think they would ever look at limiting any portion of our transportation system because of COVID? From Sandra.
So I'll address it. I mean, I think it was today in the Wall Street Journal, the Trump administration, it was discussed that of limiting air traffic in and out of the hot zone areas. So I know it's at least being discussed, especially in those hot zone areas. Will it come to a point where they start limiting us even driving around between states? I have no idea. But at least from what I have read, there is discussion about limiting transportation from those hot zone areas.
And she clarified a little bit, Brian, she was meaning anything beyond personal travel. So like, transportation of goods and services or, goods and stuff.
Sure. Well, I know related to what Greg was talking about on the crop inputs and some of the concerns down in the planting season. Those concerns go to the transportation of products into our ports. That's something that people are keeping an eye on. Right now, it's more just we need to be aware of this potential issue. So like what Greg was saying, and then like last week, I was saying if you have a pretty good idea of what you want to plant and what your needs are, you might consider locking in those supplies. So it's still really, the situation is so fluid. We're still trying to figure out, what are all the ramifications and what could they be? But it is something being discussed.
Hey, Brian, I noticed just before we got on with this meeting, there was a story in the journal about apparently China is changing some of the ways they will allow exports out of their country, and it's affecting like the overnight airline places for supply issues. So I hadn't had a chance to read that yet, but apparently they made some changes over there in China.
And we had a question about China. Wouldn't China use the lower animal protein costs to make purchases?
All else equal, yes. That's what I was trying to allude to earlier is, those goods are available cheaper than they were a month ago. Some earlier question alluded to the politics around the trade agreements. We can't ignore that, but on balance, yes.
And then a little bit related, total world protein demand for the year shouldn't change much, right? And that's from John.
Dan, you can comment on grain protein demand. I'll speak to meat protein demand. On balance, meat protein demand tends to go up with good economic environment and incomes, and it goes down without. So I'm not as optimistic on the macroeconomic environment as I was a month ago, so I'm not as optimistic on global, at least meat protein demand.
I hope I have the right perspective on this, but I think that governments will not want to be caught short on food and will become more risk averse. So at least in the short run, they're kind of like people in our grocery stores. There's a human tendency to protect oneself and to have more than adequate supplies and to build stockpiles in a risky time. So at least in the short run, there'd be a demand pull. But once you get to those levels, then it levels out, and I hope you would not tend to stagnate the market some because everybody's already quote full up. But So it may affect the flow, but not the overall quantity in the long run.
And one here, does the cull cow market stay about the same, or does it shift lower? So asking about cull cows.
So if you agree with the notion that we pulled forward and shifted some demand to fill freezers and we don't need the same volume of ground beef in the next 3 weeks we have the last 3, that's not supportive of the cull cow market. So I anticipate the cull cow market to be lower in coming days.
And the next one, how long can the feedlots hold their current inventory if plants start to slow?
That's tough. So weights are above where they were last year. You can produce animals that get really, really big. We've done that before. But then you have that much more meat. You have animals that are bigger than plants are meant for. How long? I can't really tell you. We're in uncharted territory in that context. In 2015, Iowa had animals that weighed about 120 pounds more than we had in Kansas because of some unique basis situations and so forth. So we do have experience with producing bigger animals, but that can quickly depress cash prices. But you can certainly put a lot of pounds on an animal. It's just at what point does that no longer make economic sense? I think you're going to have growing interest in quote unquote slowing down animals. So getting heavy animals in maintenance mode the best you can to slow down the rate of gain is what a lot of yards will have to start thinking about if in fact we have limited access to plants compared to what we had a couple weeks ago.
A little more of a general question. In past recessions and depressions, ag has been hurt as much or more than any sector. This feels like energy and hospitality and retail may be worse and ag may be not as bad.
I would agree that for this, if we're in a recession, how long could we be in it? The energy and hospitality sectors are really hurt. The consumer is hurt. Manufacturing is hurt. Ag right now, it's maybe holding up okay. But I would maybe, push back on the notion that things are going to be really rosy on the backside. If we look at the 2008 Great Recession, certainly at the start, it was very volatile for agriculture as commodity prices were fluctuating heavily. But once we made it through to about 2009, 2010, agriculture took off. And the big reason it took off was there was a huge amount of demand that was out there for our products. And we were able to meet it, and that pulled our incomes way up. Where's the demand right now? We just heard from Dan on the ethanol side. Doesn't look very good, doesn't look very promising. Maybe there's some, feeding China with their African swine flu that they have, and looking at maybe helping push in with the phase 1 deal. Maybe that could be the demand. I guess what I'm saying is it's maybe not as clear of a picture for agriculture as we move through this era. So again, that would just be my prediction, but maybe, I don't know, Glenn, Michael, Dan, Greg, if you had another response to that.
Brian, I agree. I'll add to that is most sectors have grown here domestically under the notion that we're going to be exporting more than in the past, playing off of U.S. comparative advantage and producing different things. I still believe that holds, but that is at risk if the world is moving into more and more of a populistic, we don't want to be in a globalized world. I alluded to this a week ago. I remain quite concerned about that. So that's important from a demand perspective to pull ag forward on the back end, as you said. So I agree with everything you said, and I share those concerns.
And Dan O'Brien had a note that he notes ag's ties to energy via the ethanol market may involve us more than in the past in some ways.